welcome to the first installment of Integrity Group videos to try to help you learn how to sell life insurance. So today we're going to be discussing life insurance. There's two different types of life insurance. There's whole life and there's term life. Whole life lasts a lifetime. Term life lasts for a period certain, whether it be 5 years, 10 years, 20 years, or even 30 years. Okay? So the life insurance that we're going to be talking about today are these two. The rest of them are relevant to us at the Integrity Group. We really don't do any of the universal policies or whatnot. So let's talk about final expense. What final expense does is it covers funeral costs, doctor bills. It lasts you your whole life. It never goes away. The rates never increase. And the best thing, your policy can never cancel. So let's explore that a little bit. So when someone passes, the average bill is anywhere from $8,000 to $10,000, right? Maybe even more. So with whole life, it builds cash value. It lasts you for your whole life. And you can plan because your rates never increase. And usually when people are on whole life policies or fixed incomes, it's because they don't have variable income that's coming in. So they got to plan out what's gonna happen, right? They have to plan out what their bills are gonna be, right? So final expense is usually a whole life policy. It's usually a whole life policy. Now, we primarily deal with final expenses. Why? Our customer base is 65 and older. That's our customer base. That's who our clientele is at the Integrity Group. Now, if you have a younger clientele, you use term life. Term life, what that's for is it is for covers a major debt. So, like young folks, they have credit card debt, they have mortgage debt, they have they buy cars, right? They buy things. Seniors not so much. Their house is paid for. You know, they don't really have credit card debt, and usually their cars are pretty much paid for, right? The only thing that they really have to worry about is their final expenses. But young folks, we go out there, and I can't say we anymore, but we go out there, we get our credit cards, we get our big cars, and we go for our mortgages. So if something should happen to a loved one, let's say they have small children or they have a wife and they've got all this debt, how do they pay for it?
Credit card. Their credit card.
Yeah, they have credit card debt, but so like what I'm saying is they insure themselves with a term policy, whether it be 5, 10, 20 years, to make sure that if they die, it takes care of their family. So usually these are larger policies, like $250,000, $500,000 policies. Now, why do we use return premium on these policies? Because it's zero chance of loss, right? Zero chance of loss. So with every single term policy that we have, we do the return of premium just because we do not put people in bad situations. In a term product, if you have it for 10 years and it runs out, what do you get with no return of premium? Nothing. So what we do is we do term with return of premium so they get their money back. It's called being self-insured. It's like a forced savings account. Okay? A forced savings account. So there's zero chance of loss for the client. All other term products are bad. Because we only deal in certain stuff, right? We only deal in certainties. We only deal and help people with their situations. If we gave products that did not pay out, would that be a bad thing? Right? So that's what we do. We protect our clients. So at the end of the 10, 20, 30-year term, what happens with return of premium?
You get all the premiums you paid back.
They get all the premiums that you paid in back. So it actually makes them whole again, right? Every penny that we spend. Now, and I'm just telling you what I believe, because the term products that some people believe invest the difference in your money from what term costs and what whole life costs. This is the real truth about it, okay? There's a whole group of people out there that's what they believe, invest the difference. This is the truth. And if y'all don't believe this, then you just look at your own lives. But this is what I'm going to tell you. When your refrigerator goes out, what do you have to do?
Replace it.
Buy a new refrigerator. When your tire gets a nail in it, what do you have to do? Get a new tire usually, right? So what that's saying is life happens to us all. So I don't know about y'all, but most of y'all are above the age of 18. And if Invest the Difference really worked, you would have somewhere close to $50,000 saved up in a savings account. That's at age 22 from the age of 18. Does anybody in here have $50,000 saved in a savings account? Not a trust fund, I'm talking about where you actually put the money back and saved it. No, no one does. Do you know why? Because Invest the Difference does not work, because we have our lives that we finance things, and we just put our budget out over and over and over. Hey, I can afford that, it's only $30 a month, right? And then when an emergency happens, we're like in a panic because we don't have that cushion. So that whole lifestyle of people saying invest the difference is bullshit, bull crap. Whoops. Bull crap, because it's not how people truly live. Okay? Okay, let's cut that because I screwed that completely.